I'll just do a quick introduction and then we can start. I think we've all heard a lot of stuff on the budget. But long-term capital gains tax 12.5%, short-term capital gains tax 20% equity, everything normalized to 1 and 2 years. Real estate gets no indexation. Bunch of changes around small. I mean, this is actually the biggest set of changes, but I think there are a bunch of changes around gold, which has a lower. So it's fallen 6%. It should fall another 1 or 2% soon because it will equalize now, along with the foreign rates. And here Ajay is here. And Ajay, are you here? Are you able to hear me? I don't know if you can. I can't hear you. Okay. Okay, he's on mute. Sahil, are you able to hear me? You are. Okay. I don't
We
know.
can hear you.
Okay. Awesome. Great. Okay. So Ajay, just to welcome, do you wanna quickly do an intro and then we can start? So I think I did the very very salient features, but I'll let you take it further before we get the speakers on board.
Hi, Deepak. Deepak, audible?
Audible? Yes.
Am I audible?
Yes, sir. Yes, sir. You are.
Okay. So I got the last bit of sort of the context that you were laying down. I think overall lot of changes, and for once in the last many years, I've not found a devil in the detail. That's the one positive that I want to start with, because otherwise you would find something, and something from as big as the retrospective Vodafone amendment in 2012, which was never mentioned in the speech, by the way, by Pranab Mukherjee, and we found it in the bill, to equalization levy, which was introduced a few years back again in the bill. No mention of it in the speech. No such bombs, no such devil in the detail. And I really don't think there's anything hugely negative that is there. While she could have done many, many things, all of us will have a list. Could it have been better? Definite, as always. Uh, no bombs like even the TCS that was there in her last full budget. So nothing of that sort which will shake us up. Uh, Capital gains, I think rationalization, making it simpler with fewer rates, fewer asset classes, fewer period of holding is welcome. Definitely minimizes it. This is something that, even though we were seeing it daily, we would always to be sure look up whether it is listed, unlisted, non-resident, resident, 36 months, 24 months, 12 months. That's what we were used to in life, sort of always look up to it. And I think today that has got changed quite a bit. Personal taxation, again, could the minimum amount not chargeable to tax, the slabs, could it have been increased? Could it have been taken up? There's always scope for that. I don't think it makes huge difference collection wise, because if you've seen the numbers, while only 3% or 2 or 3%, whatever number of people file returns, uh, more than two-thirds of those are below 10 lakh rupee limit, and more than 50% of the entire collection in personal taxes comes from, again, the top single digit percentage. So by moving it up to 10 lakhs, I don't think she would have lost too much revenue. But from 3% of the people filing return, we would have probably become 1% of the people filing returns. So I don't think that anyway was something that would have been done, and it doesn't give too much of a relief other than optically people feeling that there's not much done for the middle class, etc. Overall, I think for me, like I said, simplification of some of these tax things, there are a lot of it procedurally, and I won't get into those details because that doesn't impact all of us on the calls. More importantly, I think the fiscal discipline that they've stuck to, getting and a clear path, 4.9, 4.5%, and even right from COVID years, when there was always a temptation to sort of overdo things, they have not done that. This year, I personally was always expecting that there would be some dole outs, some handouts. Absolutely nothing of that sort. No new handout schemes, etc. If you see, nothing at all. So quite a few positive things. uh, are there things which are misses which could have been done? Definitely there would be, like in any other year.
Awesome, awesome. Great. Okay, so shall we start with the speakers? I think I have a bunch of questions, but I'll ask them later. Venkat, would you want to start?
Yes, Deepak. Deepak, so I had, first of all, thanks for letting me speak. I had only a couple of quick points that I wanted to make. First is a question. Given and I will leave that both to you and Ajay sir to address. Given, I mean, I understand the need for rationalization of, LTCG and STCG across asset classes, and as Ajay sir was saying, all this 24 months, 36 months, land, gold, all this nonsense is done, and that was long over. All that is okay, but given the tax buoyancy, the tax receipts, etc., and the fact that we are, I think, above budget in terms of receipts, was there a real, just from an optics perspective, right now, I had even tweeted this today, that 2.5% LTCG change does not impact people like me materially, right? I am a buy and hold forever kind of guy, so it does not impact me materially. But just on 2 points, right? First is, optically, does it make sense? Point number one. Point number two. All investors, right, look at post-tax returns, and changing, taxation, especially in something as serious as LTCG, every now and then. I think what this is something like the second or third change in 6-7 years now, is not good, right? So I just want a quick comment on that from you, and then I had one small point to make on the economic survey. I will just make that once you address this, if that's okay.
Quick note from my side here. I think it's an intermediate step here. 12.5% is not a number that I think we're going to finally get. So we're eventually going to get either 15 or 20 on long-term capital gains also. But this is an intermediate step to get there. That's why the 12.5 exists. So literally my feeling is, if you have things that you want to exit, then this is a good year to exit, because I think over 2 years, she will increase it to 15. It will go, it will take a trajectory of its own. Or they may make it 20 for short term, 15 for long term, and leave it there. I don't think this was massively a revenue generational exercise, because I doubt they would have put capital gains as a huge amount, given that in the last time when they did tax increases in LTCG, the next year was not very good for the equity markets, and they wouldn't have earned a whole lot of capital gains at that time. Uh, there is, of course, some other rationalizations that they've put in. So they've equated real estate, they've actually brought down real estate capital gains tax for people who've held real estate for a really long time. So effectively, they'll pay lower tax. They have also brought down long-term gold holding rates. I mean, capital gains tax also effectively. So I think there's a bit of that. Therefore, they want to numb the blow. It sounded, I mean, I think it's a little rushed, because they could have done this in the next budget as well, because this year they had no fiscal issues at all. So it's only about 6-7 months before the next budget. So you could have done that, and then you don't have all these July 23rd, 2024 sitting in the finance bill forever. But apparently for now it's there. So, but there's also the fact that they're revamping the income tax code, which means this whole income tax act may be rewritten entirely. That's my view. Ajay, did you have anything to add?
No, I agree with you. Just one point to add, Venkat, there is, when you rationalize multiple slabs, multiple rates, multiple period of holding, I think it's never about the revenue thing, but there will be some classes which will gain, some classes which will lose, some which fell from 20 to 12 and a half, some which will have gone from 10 to 12 and a half. Not comparable, but if I were to take a similar thing to say that there has to be one rate for GST, let's assume we take that decision and move, and you will fix that rate somewhere in between. So there will be classes which will go from 12 to that 15 or 18. There will be some which will fall from 18 to 15. So when you pick that midpoint, there will be places where for some it will be a gain, for some it will be a loss, and I don't think it has to do with any revenue thing. And in terms of the rate, these rates, there is no method, there's no scientific basis to say this is the rate where we have to be and things like that. It's just a number that really the government picks it. There's no explanation needed, or there's no explanation that they owe. So I think if they were to rationalize it, could they have done it at 15? Maybe yes. 20? Yes. But doing at 20, everything would have moved up. Therefore, they would have chosen 12 and a half, 15, whatever rate that they would. And if you heard, the revenue secretary actually said that we are not going to tinker with capital gains again for a while to come. So your first point on there have been too many changes, I think this is something that's going to remain stable for a while, and they may not tinker with this for some more time. Maybe a little bit of change in rate here and there, but not asset class, not period of holding.
Cool. Can we, yeah, is Venkat, can you hear us? Is that okay?
Yeah, Deepak.
Awesome.
If you
You
want
had
to give
some,
others
you
a
said
chance,
some point to make on
I'll
the
just
economic
wait.
survey.
Yeah, Deepak. So I think you had also. I'm not. I don't remember if you had, but I just picked this up in the economic survey about the chief economic advisor. Is it talking about the quote unquote excessive financialization of our capital markets and how that creates assets and so on. And I had also sort of got a sense by speaking to a few people today that one of the reasons, though that does sound a little bizarre, one of the reasons why there have been all these tax changes in STT and so on, is to sort of stop this kind of financialization. Right now, that should ideally, and this is a comment from me, not a question. That should ideally see the problem that we have in our country today is. We are by and large, and to not to call a spade, we are a fundamentally unproductive economy, uncompetitive economy, right? So without any factor market reforms today on land, labor, cost of capital and power, a lot of money is going to go back into the capital markets, right? So I don't understand why the government is taking such a grim view of financialization. It's a good thing eventually, right? You do want savers to come into the markets, right? Eventually, you would want our markets to be sort of live and die on the strength of the Indian investor and not an FPI, right? So I just wanted your comment as well and Ajay's comment as well on that.
Okay, I'll make it quick because I think a lot of people are waiting. So I think the term was probably used for some things like complex financial derivatives, but they use the word financialization, which is, I think, unfortunate. But financialization has never hurt economies. UPI has changed our lives to a point where we can literally laugh at most Western countries where they don't have instant transfers and they take days. So I don't think it was financialization that was meant. But you're right. I mean, I agree with you on the other points. So in a way, you're preaching to the choir. Thanks, Venkat. I'll move to focused. Are you around?
Yeah. Hi. Thanks, Deepak. Thanks, everyone. Yeah, I have a few questions. Can you hear me? Hey, can you hear me, guys? Yeah, okay.
Yeah.
First question is on the NPS. There are few changes on the NPS front, right? The 10% to 14% for the private companies. So is that applicable for the old tax regime as well, especially that 80CCD2? So that is my first question. And relate to the NPS again, like for 80CCD1, it is kind of confusing because with the condition like they are saying it is applicable for new tax regime only, the 10 to 14%. So now under the new tax regime that is applicable, that
Yeah.
80CCD1.
So the 10 to 14% is only under the new tax regime, not under the old tax regime. The employee should have opted for the new tax regime. And this 10 to 14 is really a deduction for the employer's contribution that is there. So therefore, in that sense, it does not really impact the employee from a tax deduction perspective. It's really a higher deduction that the employer gets for the contribution that they are making. But that 10 to 12 jump, the higher deduction that is provided is only in case the employee has opted for the new tax regime.
Mm-hmm. Okay. Yeah, thanks, Ajay. Another question is about this gold. Because of this reduction, and there is some rumor like RBI intentionally not releasing any new SGB schedule. So any correlation between this, reduction in some tariff for gold and then no schedule for the SGBs so far this year? Sovereign gold bonds I am referring.
Oh, my feeling is that the SGBs will come on their own, but now that the price has fallen, um, they may or may not be interested. I don't know, because the price of all SGBs in the market will also fall correspondingly, with about 6 to 8% they should fall. So I don't think there's any correlation. I just think that there's a timing issue.
Okay. Yeah. Thanks,
Cool.
Deepak. Thanks, Ajay. Yeah. Yeah. Let's move on to
Thanks,
other
thanks,
people.
Venkat. Focused investor. Are you
No,
available?
I just done. No, that's me who asked just
Venkat,
the
can
last
we
question.
take you later? I'll just get focused on that.
Yeah, yeah. You can put me back down, Deepak. No problem.
Oh,
I'm not able to move. That's the thing. Just give me a
oh, you didn't
second.
have anything to say? Okay.
Okay, I'll just leave and join back. I'll just leave and join back.
All
Just
right.
give me a
Thanks.
second. Yeah.
Deepak, I am
Sure.
already done. You can
Ankush,
move on to another person. Yeah, Ankush.
sure. You'll have to mute yourself. That's all. Yeah. Ankush, do you want to take the stage? I think I'm circled back around. Satya?
Hi, Deepak. Can you hear me?
Uh, Hi, Satya. I can hear you. Please go ahead.
Thank you so much for this opportunity. Firstly, this is about the taxation on buyback. So I think it's a really good move that they made the taxation in the hands of investors. Otherwise, it was actually tax in the hands of company, which was paid from the reserves of the shareholders, existing
Yes.
shareholders. So yeah, I think it's a good move. Coming to my doubt, it is now considered as a dividend, and
Correct.
the cost that you pay to buy the shares is considered a capital loss. Now,
That's
what
right.
I didn't understand is and they're saying that this capital loss can be used to set off future capital gains,
Yes.
but as per the memorandum as read, it says that you could actually set off against the profits from the sale of same shares. I was wondering if I could set off against sale of any other shares or any other asset, or is it just
Oh,
from this? Of course, same shares doesn't make sense. What if I tendered all my shares and then
yeah.
I'll be just with capital loss? But that
Yeah.
point is not clear, so I thought I'll just get a clarification on
Sure.
that. And also
So,
on the point on the ability or the provision to carry forward your capital loss. For how many years would that be?
yeah. So you can. So let me just get to buyback, and I'll take a couple of steps back. See, earlier, before dividend distribution tax came, and before a dividend, when it was taxable in the hands of the shareholder, buyback was always taxable as capital gains. So if you tender your shares for a buyback, you would reduce your cost, and whatever the company paid you would be like any other sale on, for example, on the floor of the stock market, and you would compute your long term or short term capital gains and pay tax on capital gains. When they introduced dividend distribution tax, they taxed dividends in the hands of the company and not in the hands of the shareholder. So there was an arbitrage. Companies were doing buybacks because then it was going as capital gains, and otherwise dividends were getting paid by the company. Therefore, they introduced buyback distribution tax to actually sort of equate the two and bring in parity. So they said if you are paying dividends, you would pay a dividend distribution tax, which the company would pay at 20%. Therefore, even if you did buyback, you would pay buyback distribution tax 20%, and the company would pay. When we moved back the dividend taxation from company to the shareholder, we didn't do away with the buyback distribution tax. Therefore, that disconnect remained. Now they have brought back buyback distribution tax also into the hands of the shareholder. So what they have done is the buyback amount, the entire amount received on buyback becomes taxable as dividends. Therefore, if you paid something to buy the shares, that would become a lost, or that would get lost if you tax the entire thing. So they have said you will be able to carry that forward or use that up as capital gains. So it will become capital gains. And if you have held the shares longer than a year, it becomes long term, otherwise it's short term. And if it is long term, you can set it off against any other long term gain you have, other shares, other assets, any long term gain. If it is short term, you will be able to set it off against any income like normal short term loss that you would have in the year.
Oh, that answers my question. So you're
And
saying that
if it is,
I'll be
yeah, long term, sorry, the last part that you asked, long term, you can carry it forward for 8 years.
8 years. So the same set off and carry forward provisions will be applicable for
Absolutely. It
this
becomes like
also.
any other long term capital loss or any other short term capital loss.
Yeah. And slight confusion on this gold and international mutual funds. What would be the holding period now? I mean, of course, it will be applicable from 2025, but what would be the uh, holding period to be considered as a long-term capital gain? Would it be
For
24
for for the gold funds or your
gold
physical
funds?
gold.
Gold funds, ETFs.
So that becomes 12 now.
Is it because
So
why is it
whatever is
12?
listed, whatever is
Okay.
listed becomes 12 now. Whether it is your gold ETFs, REITs, InvITs, all of the things, including bonds which are listed, become 12 now. The only thing that remains 24 is for other unlisted assets like physical real estate, unlisted bonds, physical gold. All of those are 24.
Deepak, I want to bring you in here. Do you think gold ETF and fund is considered listed?
Yeah,
Pardon
that
if
is
it's
a
a
question that I wanted to ask because does the listed take precedence over? So gold, of course, will be um, 24 months, but will the gold ETF be considered a mutual fund that holds gold and therefore it's 24 months, or is it because it's listed?
yeah,
It will be considered 12 months. I think there's a bit of a confusion over there because then even listed bond ETFs, which are like the CPSE, I mean, there's this Bharat bond ETFs, they would also automatically become only 12 months. And then I think that
right.
is not really
Yeah,
sorry, the intention.
yeah. I, there
So
is still some gray area there, but I'm sure that
there,
over
I
the
have
course
to,
of time
I
it will
mean,
be clarified.
I haven't read the bill, but there's also, I think, another impactful point I want to ask actually Ajay over here was on the buyback. The company still pays the buyback tax, correct?
Oh yeah, that's a good point.
If it does a buyback, I'm not sure. Ajay, are you there?
Sorry, I was
I
on
think you
mute.
were
I
on
didn't
mute.
realize the company doesn't pay buyback tax, Deepak. 115 QA, which levied buyback tax, doesn't apply after 1st October 2024.
Okay. Sure. Thank
So
you.
Oh
now,
Thank you,
wow.
whatever,
Ajay. Yeah, I just
and,
want to
and
say thank you. Thanks. Thank you. That's all
yes,
from my
Awesome. I thought this will completely remove buybacks from the table because the companies had to pay buyback tax as well.
no,
But
no.
actually, what you're saying is they don't have a, yeah.
Yeah,
So
they don't need
you
to.
will still get buyback.
Yeah, companies don't need to pay at all. See, Deepak, on the other thing, no, it that lower holding period was always for listed securities, and they had put within brackets other than a unit. Now they've taken out that other than a unit. Therefore, unit of a ETF, unit of a gold ETF, silver ETF, REITs, InvITs, all of that become 12 months because they've taken out that other than a unit. So any listed security is 12 months now.
This is amazing. That means literally any ETF that is
right.
listed, even if it invests in bonds, is 12 months.
Yes, it will be 12 months. I think except for overseas holdings, which will continue even if they are listed because that doesn't become a listed security as defined under the SEBI regulations.
Yeah, it's not listed in India.
Correct.
Yeah, but a Nasdaq ETF is in India, is listed in
Yeah.
India.
The one
Therefore,
that the India ETF which invests overseas, you will still get the listed security definition.
oh, this is incredible. This is incredible. Thanks. Awesome. Thanks, Satya. I'll move. I think we've got Bruce Wayne.
Hi Deepak.
Hi. Hi. Can you hear me?
Yeah, Deepak, you can hear me?
Yes, please carry on. Yeah, please go
Yeah,
on. Yeah.
Deepak. Uh, Fan of your spaces and Capitalmind podcast, and like the way you simplify the complex finance for the layman normal people. So I really love that. So maybe in your style, can you just explain? Yeah, put in simple words that what does this budget mean for a normal, say, service class passive investor who mostly invest in SIPs, occasionally buys these ETFs, and once in lifetime buys a home loan and things like that. So if you can put in like simple words, how does it impact, or changes, or nothing changes? Yeah.
If you're a passive investor, nothing changes. Nothing much changes. You'll just pay a little more tax when you exit, when you do, and you can't say when because you don't know what the tax regime is then. So just do what you have to do. I think otherwise there's not much more to say. Um, but thanks again. Great. Should I switch back to who have I not done yet? So I think we should talk to Anil, Nitesh, and then Manoj. Nitesh, sorry, who's everything changed in my.
Yeah, okay. Yeah, hi
Okay,
Deepak.
sorry, go
Can
on.
I speak? Nitish here.
Nitesh, yeah, you go then. I think Ankush has raised his hand. I tried to get him earlier, but he wasn't able to. But you speak first and then Ankush.
Okay, fine. I'll let Ankush speak, then I'll speak. Yeah.
Okay, that also works. Ankush, can you take the stage?
Yeah. I'm audible. Thank you for the opportunity.
Yes, you are. Thanks.
Okay. I want to understand this LTCG changes in real estate. How is it now different from a retrospective tax? Because is it legally contestable, and is it a retrospective act on grandfathering and indexation benefits?
Yeah. So, is it a retrospective tax?
Hope I was audible.
Yeah, I get that question. So, if is it retrospective tax without indexation by increasing it to 12.5%?
Deepak, was I audible? Should I repeat it?
Are you able to hear me?
Ajay, I'm able to hear you. Ankush, can you hear Ajay?
No, I can't hear Ajay, but I can
No,
hear
but
you. Hope
Oh,
my question
yeah,
was
your
audible.
question
yeah,
was
yeah,
clear.
it is
We
audible.
can
He's
hear
actually
Ajay as well.
replying.
Are you able to hear me now?
Okay,
Yeah.
you can convey it to me post his summarizing something like that.
Yes, it's recorded, so you can check it back. Yeah. Ajay, go on. Yeah.
Okay, fine. Go
Okay.
on.
So, is it retrospective? In a sense, very technically, yes, because of a asset that you are already holding, you're losing out on indexation. And could they have done it only for assets bought after today? The answer is yes, they could have done that. But one of the stated objectives of the FM was to reduce the number of different asset classes with different treatment and different rates and different holding, etc. So, grandfathering assets which you were already holding wouldn't have fit into that scheme of things. That way, any rate increase would become a retrospective tax if it comes to capital gains, because you're already holding the asset and then the rate increases. I don't think there is any basis to challenge this. In any case, the government has the powers, the legislature has the powers to make retrospective amendments. I don't think that would be an issue. Earlier, when they brought in long-term capital gains on listed shares, this was in 2018, they did grandfathering, because at that point they said we will not tax anything that's been held for long. There they were moving from zero to whatever percentage. And here, if you see, even for real estate, there was always, even for other unlisted and other assets which were you could index, there was always an option either to pay 20% tax on capital gains after indexation or 10% without indexation. So technically, it's just a rate increase, and I don't think there is a case for any retrospective tax or anything like that. So while it applies on assets which you're already holding, I don't think it's even very strictly can be called a retrospective tax, because it's just a rate increase.
Agree with you here. I also think the government has the guns, so they can do what they want.
Yeah.
But
Yes.
um, okay. I think since that is kind of done, we have one of the things that I would like to say in real estate is that this actually may benefit a bunch of people in some way. Of course, it won't benefit them because you earlier had a 10% option. Now you have only a 12.5% with no option. I don't think this is a bad thing to just get everything normalized into one rate. But yeah, Nitesh, do you want to take the next one?
Deepak, if I may,
Oh, sorry, I think Nitesh is connecting, it says. Um, Ankush, did you have something else? I saw you unmute yourself.
yeah. Yeah, I have a complementary question to that one. I'm not asking about the legal. I'm okay with the legal, but government can do anything on this part. But is it principally a retrograde act? That's what I want to know. Because what's the message they want to send at large?
I don't think it is a retrograde act because I think.
Sorry, I can't hear Ajay. So if he has answered it, sorry on my part. I would later get it.
Yeah, so I don't think it's a retrograde act, and I think the larger objective here is to simplify the capital gains taxation, and I don't think there are too many revenue considerations here. I think this whole indexation not being available, my personal view, is being blown out of proportion in terms of what can happen, and I really don't think so many people would actually be impacted, my personal view, because a lot of the long term capital gains, especially on real estate, most people either pay tax, and for them, 2.5% would not really make a huge difference if they've made a huge gain. But if they're not, a lot of the people actually reinvest in properties and get a tax exemption as provided for long-term capital gains in real estate. So for them, whether it's 12.5, 15, 10, etc., may not matter too much. I think once the dust settles down on this, we will actually realize that it does not impact as much as we are today thinking it will.
Good point. Good point. And it's the only asset class that allows the reinvestment into the same asset class without
Yeah,
taxation.
and
You
also,
can't
Deepak, if
do
you
it with
see,
anything else.
yeah, if you see globally also, there is no adjustment for inflation that anybody actually permits. And even if you were to technically see, and you are a better judge on this point, is why should only one asset class get an adjustment for inflation? Why shouldn't I get it on equity? Why shouldn't I get it on everything else? Because why is it that inflation adjustment is so important for real estate but not for other asset classes?
In, agree completely. It all used to be there. Then they
Correct.
made everything
Yes.
without
Correct.
indexation.
Correct. So therefore, that is, you can look at it as an alignment of all asset classes into one thing, which is a good thing, and there is a small cost to pay for that in certain cases.
Awesome. Awesome. Great. Thanks so much. And Manoj, do you want to take the stage? After you is Amarnath.
Hi Deepak.
Yes, sir.
Am I audible, Deepak?
Yes, sir. Yes, sir. Boliye, sir.
Okay. Sir, I am not able to understand this terminology, all this thing. All financial assets should have the same taxation, otherwise it's difficult. I think it's a active economics, like budget come every year, and every asset class has something to offer at a particular stage of thing. If equity needs more favorable term, then it has to have different taxation. Now they believe equity is important, but anyway people are going to invest in it, so they are increasing it. But maybe sometime housing need better taxation, sometime maybe you need equity, because every asset class is offering something. I'm like, how much difficult is to remember the rate of return of 3 4 asset classes. There are so many compliance on GS, other point of business. So why this using this criteria boss, all has to be same here. This is not so difficult thing. It is what is needed for active economics is more important. What do you think?
Sorry. Yeah, I think I'll take a quick stab at it. Now, because of the financialization of a lot of things, like for instance, even real estate can be tokenized and financialized using REITs. If you have a different rate of tax for real estate, for REITs, and for equity, then it's complicated from that perspective, because if you have a company whose only job it is to own houses and it's listed, or if there's a company which is an REIT, which is an REIT whose units you invest in, or directly real estate. Now it's almost all equalized. So you can invest in either one of them without having a taxation differential for one versus the other. There is still a taxation differential, because if you invest in equity, you can take the long-term capital gains on equity and buy a house. You can't do it the other way around. So that differential has to go someday, because I think it's unfair on equity. But I feel this kind of equalization kind of helps when you have a tokenized and financialized system. Then you don't have to make these choices in between the asset classes.
Okay. And what is this grandfathering thing in this real estate? Yeah.
नहीं ये grandfathering पहले से था. If you looked at the earlier acts, if you had a house which you had bought before 2001, it was always the
Yes.
2001 price that took precedence, and on that you put in say indexation and
Yes.
calculated your price. Now you don't get indexation.
Yes.
That's all.
So,
Every other cost.
so indexation benefits won't exist even for properties that were bought before 2001?
Okay.
Yeah, because you
No,
get the 2001 price and then it's the cost. Sorry, Ajay.
Correct. You're right, Deepak. What you said is right. That's what I was about to say.
So we have to take 2001 cost and pay 10% and 12.5% tax. That's the way it is.
Correct.
Yes.
Okay.
The thing is, if you have taken a loan to buy a house, I think the interest part can be added to the cost of the house because of some judgment I saw.
Yeah.
But
There's
Ajay,
a
you can
there's a
correct me if
judgment
I'm
on.
wrong.
Yeah, there's a judgment, but that sort of, you need to test it, etc. But because as per the law, it is cost of acquisition and cost of improvement. So you do any improvements to the house and you
Correct.
do major repairs, painting, and get it to a shape, etc. Those can be part of the cost. But yes, there are one-off decisions which say that interest, if it is wholly for acquisition, etc., you could do that. But you should not have claimed a house, your loss from house property, etc., on the very same interest again.
Correct.
Okay. But I still believe that this same asset class, if I have three kids, one is hungry and one is stomach full, I am going to give the same amount of food every day. I think it should be niche based, but okay. Because every asset class is a need of time, na? So you cannot have that, okay, this is needed, but I want to maintain the same.
No, I think you can do this for some asset classes at some point in time, but I think all of these things should have sunset clauses. The equity, when it was created, was also because they wanted to increase the enthusiasm for equity, and then it got a lot of enthusiasm. So now they want to tax it, which
Yeah,
is
at
fair.
that time
It's
risk
good.
was very high. At that time equity risk was very high. Today equity risk seem to be low because budget is at control, inflation is at control. The predictability of earning has gone up. Even with the increase in tax, market didn't went down because predictability of
Yeah,
earning has increased. So earlier, and the predictability of earning was not there, so risk was incentivized because we need to put the money. And now they believe anyway money is going to come.
yeah.
So
I
they
mean
are
that is true.
calculating. It is not because they are because it has to be seen.
Well, I don't know the intentions, but I can tell you that it creates opportunities almost equally for everybody. So eventually, you're going to test everybody by returns, not by taxation. So, which is a better thing in the long term, I think.
But I think you should be open about the communication, why this is happening, rather than it looks like an excuse that everything has to be same. Sawa ser baji, sawa ser khaja. I don't. Okay.
नहीं,
Thank you, Deepak.
Thanks, Manoj. Amarnath, you want to take the next one, and then Aditya, you can take the one
Uh,
after that.
yes, Deepak, am I audible?
Yes.
Thank you so much for the opportunity. I have a two-part question with respect to the long-term capital gains. One, when it was kind of reintroduced in 2018, I've been reading somewhere that it was done to encourage FPIs to come in and invest in India. I don't know if it is true, but if it is true, how would that basically work is my first question. Second question is more on abolishing long-term capital gain tax probably somewhere down the line. Is it more like riding on a tiger that the government, even though it wants to reduce the long-term capital gain tax maybe 6 years, 8 years down the line, is the government worried that, or will the government be worried that, if we reduce it or if we abolish it, people might cash out, which will lead to a crash in the equity market? Is it more like riding a tiger? Is it more of a one-way street? Thanks.
Ajay, do you want to take that?
So I think larger point. I think in this discussion, when it comes to investment and when it comes to asset classes choosing, etc., while I would like to believe I am important, actually it's Deepak who is more important. I don't think tax plays such an important role in those decisions, in my view, because like we've been talking on this call now for a while, capital gains tax rate has been not very stable. You've been changing it. Rates have been increasing, decreasing. You had zero. You didn't have long-term capital gains. You brought it back. You have STT. But you see what's happened to our equity market over the years, right? And that equity market performance returns on equities got nothing to do with your tax policy beyond a point. Of course, yes, for corporates, tax will be important, but how you tax a instrument and capital gains, I don't think is such an important thing to attract investors, not attract investors, etc. Because I think we've given tax exemption to sovereign wealth funds and things like that. How many have come through, and what has happened? And do you think they'll come because there's a tax exemption if the market is not stable, your corporate governance is not good, your returns are not good, your underlying profitability is not good? I think beyond a point, tax can't be used as a tool to differentiate between asset classes. And I think in that extent, as a pure taxman, as a tax practitioner, aligning all of these has been simplified. In terms of where to invest, I think it's you'll really go back to Deepak and not to Ajay Rotti on this.
Okay. Fair point. I think, let me then, I think that's kind of answered the question, Amarnath. Is that okay? Can I move on?
A quick thing, Deepak, in terms of my understanding or my reading on the reason behind bringing in long-term capital gain tax in 2018, is it true that it was done to kind of encourage your FPIs? Or if it is true, how would it work? If you could just brief it in a minute or two, please.
You mean bringing on tax was better for FPIs?
That's what I read, when I was Googling. I'm not really sure if it makes any sense. I couldn't really understand as to why it was brought in
No,
unless. Yeah,
the internet
yeah,
has
please go ahead,
a
Deepak.
positive answer to everything, but so I don't think it is that. I don't think the FPIs were very happy
Okay,
that they were going to get taxed. Um,
got it.
because FPIs are now taxed, mutual funds, Indian mutual funds are not, right? So technically, one institution is taxed and another institution is not. So I don't think that's
Understood. Thank you.
that's fair for India, right? So yeah. Let me move on to
Thank
Aditya. Thanks so much for waiting, and then Saurabh after this.
Yeah, I have a couple of questions. First, regarding, I think, I mean, I don't know if it is within your purview of expertise. No one has much discussed the custom duties part on today's budget. If you guys have any idea about how did the custom duties regime move in today's budget, it would be nice if you guys discuss it if you think it is within your expertise. Because mostly I have heard personal finance related tax stuff only here. And
Yeah,
second,
so I don't. There were not too many changes on custom duty, and what's happened after GST is, custom duty is only really basic custom duty. Everything is IGST, and then today your rate discussions earlier, if you remember, pre GST days, the next day of your Economic Times or Financial Express or whatever paper you would pick up would be on what has become expensive, what has become cheaper, including your ACs and cars and bikes and computers and whatnot. Today, that's no longer a point in the budget at all because none of those are part of the finance ministry or the finance minister's remit, because that goes out of your GST meetings, GST council meetings. It comes out of that. So, but yes, there are a few changes on basic custom duty. It's as limited as that. There are some changes on mobile phones. The larger thing is they have reduced custom duty in certain cases where they want to encourage, on parts where they want to encourage manufacturing in India, but nothing too significant. I don't think there will be anything significant coming out on indirect taxes in annual budget anymore.
No, I don't mean in that perspective, because I have read a couple of people saying that with regards to intermediate goods, which was one of the biggest impediments to our local manufacturing, there has been some
Yes,
rationalization.
there has
So
been.
is that
There
true?
has
Is
been.
that true?
There has been, and
Okay.
especially for sectors like mobile phone manufacturing, etc., on intermediate goods, they have reduced custom duty on some of those, and they've also reduced it for few other things, and there are a few things on aviation fuel and things like that which they have reduced. But the larger one on parts or intermediate goods for manufacture, mobile phone is the biggest one.
Yeah, the last question, the second one would be like there have been two camps of commentators on the today's taxation, or like basically the post-pandemic tax regime of this government. That is, one side says that gradual rationalization of tax regime is happening, and the other camp says that there is no direction in the policy making. There is like little bit of tinkering in each budget. Like one-time surgery, like the big surgery, is not happening. Now, after I listened to you guys today, like you guys have maintained that there is a rationalization of tax benefits within all the asset classes like real estate, capital gains from equity markets, etc., etc. And if I'm not wrong, even the TDS on insurance has been decreased from 5% to 2% across the insurance options. So if all this has been done at a big extent, so what will be the potential tax code look like if already a lot of rationalization has happened? So will it just focus on completely scrapping away with the old regime option and just reducing 5-6 slabs to 2-3 slabs, or is there more to be done next year if they bring in the tax code?
I think if they bring in the tax code, in terms of actual taxation rates, there is actually quite a bit of work that's already happened over the last few years, and it's been stable. I don't think they'll do too much. I think the new tax code will change a lot on administration, the way tax, compliances work, administration works, litigation, for example, etc. I think the real need for change in direct taxes, where you need to really do a lot of work, is on the administration. It is not on the tax rate. It is not on head of income. It's really not on whether capital gains is 15% or 12%, etc. I think we will have a long discussion only on that. There is a need to really do a lot of changes, and not surgery, not band-aids, really revamp the entire thing on tax administration. I think that's what they'll focus on in the new bill.
So basically, the real work is not in the potential headlines that may come. That is basically
No,
that no one understands the backroom work
correct.
here.
It will not be on that. You're right.
Okay. Thank you very much.
Thanks, Aditya. Saurabh, after that, Ankit, have you spoken? If you've not, then you're next. After Saurabh, yeah.
Hey, Deepak, Sahil, Ajay, thanks for the opportunity. Uh, I have a couple of questions. First is the funds that were bought, debt funds, which were bought before April 2023. Does the indexation apply to those funds, or even that goes away? Second is, what about the long-term capital gains, which was exempt for sovereign gold bonds? Even SGBs are listed. So, is that also taken away, or it's still in the fine print?
Uh, so that also is taken away, because let me just, I was just seeing the act while I was speaking to Deepak the earlier time. So the way the provision read was that in case of a security other than units listed on a recognized stock exchange in India, or units of a UTI, or unit of a equity oriented fund, a zero coupon bond, etc., was 12 months. So you had units of a equity oriented fund already at 12 months, but all other things were out. So if it goes as a security, then it would get a 12-month period of holding clearly. And we just need to see security, and security for income tax is the same as what is meant in 2H of the Security Contract Regulation Act, which is SCRA for SEBI. So if you are a listed security on a recognized stock exchange in India, then you would be 12 months, you will fall into that definition.
So are you saying SGBs will have a
I think
long-term
SGBs will,
capital gain?
I think SGBs will come in as a security, and they are listed, and so those implications follow. But as SGB particularly, I have not examined from really reading the definitions, etc. Need to do that. But my immediate answer would be they should be covered.
And about the indexation for the funds bought before April 2023?
Sorry?
So there was a change in debt funds,
Correct.
right?
Correct.
The taxation in debt funds,
Yes.
and I think that came in April of 2023.
Yes.
So the funds that were bought before that were allowed to have indexation benefits
Correct. Those go away.
for
Those go away.
that is going to go
Yeah, that
away.
is going to go away.
Understood.
So you won't have indexation for any funds, but the tax rate comes down. So 12.5% on absolute returns. After, even if you, but you have to hold for 2 years at least. if it's a fund that is actually, because it's a debt fund that was bought before April 2023, you will get long-term capital gains tax, but it will only come after 2 years,
No,
and it
but the
will
long-term capital
have no indexation. It will be 12.5. I think. Sorry,
it's
go on.
going to be 25% and not your marginal tax rate.
Can you say that again?
It'll be 12.5% and not the marginal tax rate for debt funds as well.
I think the debt fund classification of being bought before 2023 still exists in the code. So the adding to slab rate happens only if you bought it after April 1, 2023. The before 2023, it's treated like a normal uh, debt fund, so it will have long-term capital gains tax, but after 2 years of holding. That's what my reading is, Ajay. If
Yeah, that's correct. That's correct. Debt and non-equity
Understood. Thank you
mutual
so
fund
much.
will be there.
Understood. Thanks.
correct. Ankit, and then Subbu. If you're there.
Hey, hey, Deepak, how are you? Good to be
Hey,
on the
now I
panel
can
with you.
hear you. Thanks, thanks.
Well, thanks.
Good. Please go on.
Thanks to you and Ajay for the space. I don't have a question, maybe a thought to share on the SGB and the change in the gold import policy. Might take a minute to explain where I'm coming from. Fair disclaimer: I don't have any exposure to SGB. This is just a purely from an investor perspective and thinking about a sovereign counterparty credit risk perspective. So when SGBs were started in 2015, I guess the argument or the vehicle was you basically they were bonds, so you are basically lending money to the government at a very nominal interest rate of 2.5%. In return, you're kind of getting the gold appreciation backed by the government. So government is not really backing it with any physical gold, but any appreciating price of the underlying gold price, you'll get benefit of that when the bond matures. And I think it had some early withdrawal penalties as well, but overall the tenure was 8 years. Now, when we talk about the import duty on the gold, if throughout your bond holding period your import duty remains the same, then any other that the change in the gold price is only due to the market factors, and you kind of realize that gain for the risk that you've taken for getting an exposure in the gold. Now, with the government's move of, or the budget's move of reducing the import duty suddenly, all the SGBs are marked down by 9% essentially, right? 15% to 6%, or broadly the same case. It seems to, it just appears on the face value that it's been 8 years since the first set of SGBs were issued, 9 years, and a lot more of them are coming due. So, is this move kind of a move for the government to cheapen or lessen the burden that they'll have to pay out to these SGB bond holders? And does this I mean, to me it seems like an unfair, and like an investor took that risk of lending government the money for the infrastructure development and whatnot, and when it comes to reap that benefit for that promise, because of this slight change, it seemed like the redemption price has been modified. So just wanted to have your thoughts on it. But this is what I've been. Fair disclaimer: I have zero exposure, but this is just an interesting piece that I've been thinking about since this budget came around.
Okay, my view on this is the only place where people don't want prices to go down and the customs duty to go down. So everywhere else it'll be fine. But honestly, I've been advocated for a while. I think smuggling is just ridiculous in terms of numbers. When people are trying to smuggle in gold because there's a 15% arbitrage, 6% is a lot more. I think the answer should be 1 or 2%, but maybe we'll get there eventually. I don't think it's a breakage of a promise. The gold price, after the gold bonds were issued, they actually had an increase in customs duty. So I don't think that is a complaint that people are saying, no, you're giving me more than I expected because you got 3% extra for 2 years. So cutting it down is completely the government's choice. It won't change anything for the government because the amount of SGBs in issue are relatively small. So it's not like they're going to save a ton of money by reducing this rate. But yeah, it's going to help them a little bit in terms of interest payments. Uh, but it's going to hurt all SGB holders who currently are there and people who haven't submitted their gold bonds for early whatever it is, because there's an early window for some SGBs right now where you will get the higher price pre this thing, because that's what the RBI said. Otherwise, it's going to hurt everybody, but that's fine. It's just the market. You're getting, see, basically, the idea was that you buy this instead of gold, and whenever you actually need gold, take this, redeem it, take the money, buy actual gold, and then use it for your jewelry and all that stuff. Now, you can still do that because the price of the gold in the market has come down.
No, certainly. Like I was thinking it from a pricing a derivative product perspective, that this is kind of a risk which is usually not priced in. But I get your point as well, and I mean that's almost my side. Thanks for your thoughts.
Cheers. Thanks so much, Ankit. Subbu, do you want to take the stage? Dr. Nick
Yeah,
will be
hi.
next after that.
Yeah, okay.
Hey, hi Deepak. Hey, one comment and one question. I actually think this whole thing about removing indexation is actually a pretty good idea. It just makes life simple. One way to look at it is all long-term capital gain tax other than debt, mutual funds, and MLDs is at 12.5%. So much simpler. You don't have to, have complex calculations to figure out what is the actual gains and what is the actual taxation. So I actually find the direction towards some sort of a harmonization of tax rates over the next 2-3 years. I actually find to be quite attractive. My question is around the angel tax. I think that I don't think it's got discussed till now. It's got abolished, which is great news. But I think there is some confusion around whether it is only prospectively or retrospectively, because retrospectively there are like literally hundreds and hundreds of litigations that are running, and I don't think the government has got any money out of it. Those are just disputes that are lying around. Any clarity that Ajay can give on?
It is
on
it is prospective. It is from assessment year 25-26, which is financial year 24-25, which means it's only for those issue of shares which has happened after 1st April 24. So we go back in time 4 months and not beyond that. It is a prospective amendment to correct it from this financial year. And you are absolutely right. I don't think the government has collected anything on this in the past. I myself am dealing with and handling multiple issues on this. I think somewhere, they should come out with a thing to just close out on those old disputes, do what they did with Vodafone dispute, which is first to correct it and then to say we will not pursue those old demands. And most of these issues are on really flimsy ground of valuation and whatever the officer has done and things like that. I think it's a good start that they've abolished it. The next step, in my view, would be for them to settle these old disputes and not really keep them alive. Uh, it was a absolutely ridiculous provision to begin with. I'm surprised that it stayed on the books for this long, and as long as it did, it should have gone out in the first or the second term of this government. But at least it's better late than never.
Got it. Well, so one more point slash question. I think the other point that probably affects lesser number of people is the increase in STT. Probably the most dramatic or the highest percentage of increase that has happened is actually in the STT, both for futures and options contracts. Do you think that the increase in taxation is primarily to make sure that make people stay away from this as much as possible and increase the cost of doing such transaction, or was there any other motive here?
I don't think, I just incidentally, somebody else asked me this and I tweeted about it, and I don't think tax can ever bring in a change in the behavior. If it did, I think cigarettes would have been out by now with the high tax that they kept doing to discourage it. I don't think they would have increased it to discourage these. I think there will be more on that. If at all they want to discourage that, I think they will do more from restricting, increasing margins, lot size, and things like that. I don't think they'll do it with a tax, even though there were enough rumors before the budget that they would make it speculative business and therefore not being eligible for set off and things like that. I don't think they would have done that, because if they really wanted to discourage it using tax, the increase is very small.
All right, thanks so much,
One
Ajay.
thing, yeah, one thing I want to just add over here is it increases the cost for arbitrage funds by roughly 0.5% to roughly 0.5% per year from roughly 0.3% per year. So you'll get a 20 basis point lower yield on derivatives going forward, on arbitrage funds going forward. You will also have, because the futures is where the biggest increase is 0.125 to point sorry 0.0125 to 0.02%. Options premium, the government will earn like 2 crores a day extra. 2 crores a day is chiller for in this government for sure. For at a central government, it's not going to change anything. Roughly 56,000 crores per year, per day is traded in option premiums. If you increase the premium STT from 0.00625 to 0.0625 to 0.1%, you're increasing it by roughly 50%. So, what is point? I think it's about 5 crores per day. I'm not sure, or 50 crores per day. Yeah. So it's maybe
Yeah, maybe
maybe
I
about
think
10
Deepak
to
was it a little bit more than that. No, I think it was a little bit more
no,
than that.
20 crores, 20
I
crores per
think
day, 20 crores per day.
yeah, yeah, correct. It's about 40%. If all volumes being the same, the tax effectively goes up by a third to 40%. I think the last year STT collected was somewhere in the 15 to 20,000 range. So you add another 40% to it. So like 10, 12,000, 8 to 10,000 crores of additional collection.
Additional collection, yeah, yeah, okay, okay, that is actually quite decent. So there'll be some revenue collection from there. This is like Behti Ganga types. I think you're getting it, so nobody's going to complain. So let's find out where uh, we can take the taxes to, and it will appear like it is not a bad idea, given the scale of futures and options today. Uh, uh, if it changes people's minds. Remember, also at one point, option premiums, option STT used to be on the notional value, which was ridiculous, and there was no options market only. So obviously, at some point, they will hurt the options market, and it won't work. But given that it is on the premium itself, if there are people playing this short term, 1 day options where they're trying to put 50 paisa and make it 5 rupees, that 50 paisa itself, the STT will be so little that it will not matter meaningfully, I think. So, from that perspective, the government will actually take money out of really really tiny slivers of capital and make it a really large figure because so many people are participating. But I don't think this will deter anybody meaningfully, like Ajay said. Cool. Thanks, Subbu.
Yeah.
Dr. Nick, go ahead.
So yeah, so I think thanks for allowing me to speak. And I came with a question in mind, and thankfully the conversation leads to the question that I have in my mind. So the question is that because I wanted to get this data of like how much government earning from STCG and LTCG last year, if you like where to get this data, if or this year, like. And second question would be like what the government thesis behind it, like for increasing it. And do our government has this kind of paper release, like kind of this simulation run for this, and or is just a abrupt decision, or like, or if there is a, like I mean, if there is a data available about it, or like if they do some study about it, based on that they're doing it. So where to get those things, please, Deepak ji.
Sorry, but where to get what did you say? What was being tested? I lost
So,
you
so,
somewhere in
so,
the
so
middle.
so STCG and LTCG percentage, they increase on the equity market. So it's like a very huge kind of chunk of it's supposed to be a very huge change in government revenue. So and but it also it might have any implication on the market and stuff. So do government perform some such kind of study beforehand to come up with this decision? And where to get this? Like last year, how much government make from LTCG and STCG? Like how much government get from these two sources revenue?
Okay, so I think there is an
So that
income
will be
tax.
available.
Sorry, yeah.
That will be
Sorry,
available.
sorry. Go on, Ajay.
I don't have it handy right now, but you will be able to get how much government is actually collected on capital gains. You may not have it for the budget estimates. You may not have it immediately for the previous year, but you will know broadly how much they've been collecting on capital gains.
And do like government perform some such kind of like simulation and stuff to come up with these numbers, or just kind of random,
No, of course, it can't be random, no, because every budget decision that they take, if they change the rate, there has to be a calculation of revenue foregone or revenue that they're getting. If they're giving a benefit, if they're reducing rates, the government will exactly, as in at least have an estimate of what is the revenue foregone by that move, or what is the additional additional money that increase will generate. Of course, there will be a basis. It's not just a number that they'll have done.
Okay. Yeah. So what could be the thesis, if you can like point down, like if you have like some kind of like what could be thesis behind increasing, like what they kind of trying to achieve other than revenue, right? So other than like what they
No, I think the capital gains change this year has nothing to do with revenue or collections. It's more to simplify and align different asset classes and rates. It has nothing to do with revenue, because if they wanted revenue, then they would have moved everything up to 20%. No?
Makes sense. Yeah. Okay. Yeah. Thanks, Deepak sir and Ankit sir, for answering. Yeah. Thank you.
Thanks, Dr. Nikesh. Thanks, Dr. Nikesh. Ankit, I'll let you
Deepak,
quickly
if I
speak,
may,
and then Dheeraj after this.
yeah. Just I just had one comment to add, because in the previous conversation on the STT on the options. So NSE, I mean the SEBI also reduced the exchange transaction taxes. They are supposed to go in effect from 1st October this year. So this STT raise is kind of getting nullified in terms of the overall impact to the trading community. Of course, it is on tax basis. It seems it's risen, but just wanted to give that context. That's all.
Oh, okay. Cool. Thank you. Cool. Dheeraj, go ahead.
Yeah, hi. See, my question is that, while I appreciate some people saying that the intent is to normalize multiple asset classes, right? Bring them on par as far as the taxation is concerned. But don't you think that as an economist, you always will have preference of moving the savings to one asset class versus the other? We heard in the economic survey that there is a much faster pace of financialization. So in that case, if the intent of the policy should be to promote one asset class over other, and in that case, it should not be a uniform tax rate. It should be something which differentiates the two, so that there is an incentive to invest in one versus the other. And in my view, I see that piece was completely glossed over. Your views on the same?
Yeah, so I touched
Sorry.
upon this
Yeah.
in a slightly different context. I think there's only so much you can use tax incentives to force investment, because many years back, if you remember ATC and before that, other sections which used to be there, which gave a deduction for insurance, which gave a deduction for even certain tax saving mutual funds. If you remember, the SBI used to have some, and I'm talking about 15, 20 years back. And I don't think they were able to get people to move only because, and that was, forget a tax rate, they were giving a deduction from your income if you invested in some of those funds, in some of those policies, etc. I don't think today, by reducing tax on a particular asset class, people would flock and buy those asset classes. Today there is a differential tax treatment given to REITs. They have a pass through and they have certain exemptions, certain amounts are not taxable. How many people are actually buying REITs because there is a tax exemption that is available? You would actually look at what the asset class is all about. And I don't think, even if they want to do any of that movement across the classes because of what is there in the economic survey, tax would just be one of the things. I think they will do it using other means and not really tax.
Yeah. Thanks. Thanks, Deepak sir. And Ankit, just to add, like, I think, like, if you look at the, like, the overall, 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 like, the over
Got it. And very, very quickly, if I can have a follow on, that is on the STT. Because now that the LTCG, etc., has been inching up slowly, and in future, probably it may inch up even more. What is the rationale of continuing with the STT, particularly on the equities?
No,
I can, sorry.
no, go ahead.
I can quickly take that. I think it's, Ajay will probably have more information, but I think it's too easy to collect to let go.
Correct. It's just that I think it's ease of collection.
Okay, thank you.
And today, remember, STT gets paid irrespective of whether you make a gain or not. If it's capital gains, only those who are making gains would pay. And especially seeing the data that SEBI came out with on F&O traders, how many of them actually make money and how many would actually disclose file returns with capital gains. STT it just gets collected because of the broker stock exchange ecosystem.
Yeah, but that defeats the whole
One
purpose
other
why
thing,
you keep on increasing LTCG, 10%, now 12.5%. Potentially, it could be even more going forward. Who knows? And continue with the STT. So it's just taxing. I think it doesn't sound rational or fair.
undoubtedly agree.
Yes.
We're lucky they didn't change the equity STT. But okay, just on the other question, I had this thing. I think the financialization term came from the economic survey, which is not necessarily something that the FinMin may necessarily agree with, because I don't think they would say that financialization is wrong. I think there's a statement that's probably incorrectly worded, because I don't think anybody hates financialization. It's what's made us what we are today in terms of financial might. And I don't think it's meaningless to say that don't do financialization anymore. But yeah, I'll just pause there. We have more speakers, so I'll just take it to Anubhav and then Pankaj. We'll just rotate it. I'll give two at a time. So go ahead, Anubhav, if you're on.
Yeah, thank you, Deepak. So my question is regarding the buyback. Now, since the government has said that buyback tax would be levied or rather paid by the recipient, so and now it's also being said that it is gonna be on the total amount of money that the recipient would receive. Uh, is it true, first of all, that it would be levied on the total money that recipient would receive, and if that's the case, do you expect any company to come out with a buyback? Uh, um,
Yeah, so it is the total money you receive on buyback will be taxed as dividend, but whatever you paid as the cost of acquisition of the shares or your cost that of ownership of those shares, you get a deduction as a capital loss. So in a sense, you get it under two different heads. But yes, so let's assume your tender shares for a buyback and you get the buyback price is 1,000 rupees. The 1,000 is liable to dividend. But had you paid 500 for that share many years back, that 500 would be a capital loss today. So you would get a capital loss, but you would pay dividend on the entire 1,000.
but then why would I pay 30% tax? Let's say I bought a share at 90 rupees and then tender it at 100 rupees, and I'll be liable to pay 30 rupees other tax. So why would anyone do that? Though I understand that there would be a capital loss that I could offset against something, but who would want to basically make life complicated like this? So
Yeah, so
uh,
I don't think companies would do buyback only from a tax of the shareholder perspective. They would do it if they want to improve the EPS and multiple other reasons, which Deepak can explain better. But once they decide to do that and it's taken, you as a shareholder will tender or not tender. You could decide not to tender because of an unfavorable tax regime. But I think, again, buyback would be done for reasons other than efficiency. You had buybacks happening even when there was a 20% buyback distribution tax. So I think those decisions will be driven by other things, and shareholders, each of us have a choice whether to tender or not to tender because of tax being unfavorable. And you could always sell that on the stock market today and get the treatment that you want rather than wait and tender it in a buyback scheme.
got your point, but would there be any class of shareholder who would be tendering it? Deepak, your thought on that? Because my personal
Yeah.
sense is
So
that there would not be
Sorry,
anyone who would
go
be
on.
tendering shares. I have been very active in
no,
buybacks,
there
to be
is
honest.
there.
A couple of
Yeah, there is actually there are a couple of things. First, insurance companies and mutual funds will have no problems tendering because they don't pay tax. So if you give them a price that is greater than the market price, they will be happy to tender. But this will not happen because the guys who actually do the buybacks, I mean, who will approve the buybacks are the promoters. The promoters themselves will end up paying 39% tax, 35% tax on the proceeds, and only get a capital loss which they can offset against. If they offset, so if you get 100 rupees in the buyback and you have to pay 39%, 35% tax on it, you have to pay 35 rupees as tax, right? But let's say that whole 100 rupees is also available to you as a capital loss. It can be offset against, let us say, anything else, say a mutual fund or an equity gain that you had made. On the equity gain, you would have paid only 12 rupees 50 paisa as tax. So you get the offsetting gain, which on the taxation is only 12 rupees 50 paisa, but you pay 35 rupees on the other side. As a promoter, I would never do a buyback now, unless I mean, so there's no reason why a buyback will be done. Now there's a big problem also, because you can choose not to tender in a tender buyback, but if the company decides to do a market buyback, where the promoter says, I won't participate, but try to buy back shares from the market. The current buyback rules means that the stock exchange will have to identify when the company bought back its own shares, find the seller of that share, send them an email saying, boss, this share that you sold is not going to be classified as capital gain. It will be classified as dividend, and you'll get the capital loss because it's a buyback share. That will be a negative for me as a seller because I was selling in the market. I didn't know that the buyer was the company itself. And these open market buybacks become a big problem for people in the market. This will become a problem eventually, because right now, for instance, what happens is if the company buys back its share in the open market and you are a seller, the exchange will send you an email saying your share was sold to the company itself, and therefore you don't have any capital gains tax on this share because the company has paid the buyback tax. Now it will be the opposite. When you get this message from the company, the exchange saying that your share has been bought by the company, for you the entire proceeds of that particular share, if you've sold 20 shares and 20 shares have been sold to the company, um, you'll have to pay 20 into whatever price you get as market as dividend separately, and pay tax on it as dividend, and find your purchase price for those 20 shares and call that a capital loss. So it's a little bit of a pain going forward. I don't think they've thought this particular one through, but it's not really the Finmin's problem, and now it's the open market buybacks as a problem. So we'll have to figure out how that goes.
And
Right,
Deepak,
just to add to Deepak's point, I mean, open market buyback has already been phased out by SEBI from April 25. So that's not
yeah,
going to be a problem.
correct.
So kind of
Oh, I
that has already been taken care of. So my sense is now there would not be any buyback, whether
Uh,
open market
only
already phased out by SEBI and the tender buyback basically being made so unattractive by the government itself.
only complication, and sort of I'm just increasing the complexity on this discussion here, but there is a differential treatment for foreign companies. So, because dividends, if they get a treaty access, if they do, is taxable at a lower rate and things like that, and not even at the full rate, not even like capital gains, etc. So you could have, the Unilevers and the Colgates and the Whirlpools, etc. Trying buybacks if there is clarity on the tax rate being lower with a treaty access for the foreign parent.
Good point. Good point. If it's a dividend anyway, yes, you're right. Cool, cool. Good point. Good point. Okay, I'm going to. I know that you raised hands, but Pankaj, Madan, and then Rachna. Ankit, I'll take your question later because I think everybody is getting a chance to speak. So, Pankaj, can you go ahead?
Yeah, hi Deepak. So I wanted to talk about the visible anger in the middle class, specifically the service class, that they feel that there has been very little relief in the direct personal tax. So I just wanted to understand, like, is the the anger justified, or like there is another competing view that uh, if we compare our the GDP per capita with another advanced country, the personal tax would not be that much. But another way to look at that would be, for the last 10 years, there has been no revision to the personal direct tax. So inflation adjusted, the direct tax has gone up. And also, service class, feel, that, if they are a family of one individual earner, or they have a, family of four, they have to pay the same personal tax. But if it's like a business income, so I mean, the business guy could easily put that income into four different family members' name. So the total tax outgo would be less. So I mean, so how do you feel? And just looking at the the way the government thinking and their direction, they are looking at the direct tax code. So do you think in the future there would be some rationalization on the direct tax code, or this is the way? So I just want to understand, whether this thing is fair, or like the government has a point that there is not much leeway for government to give relief on the direct personal tax.
Um, I'll give my views. Maybe Ajay is will more informed on this. My feeling here is I know there is angst, but here's the thing. I mean, your points are all valid. Why haven't we increased the ATC car limit? Why haven't we increased the tax slabs meaningfully? It's only become 10 lakhs was what the highest tax slab was maybe 12 or 13 years ago, and even now it's now it's only 15 lakhs, which is not even GDP level increase in the top slab. So it should have become 2025. I agree with that. I think we should have spread that out a little more. But it's also true that up to 7,75,000 rupees today, you will not pay tax. That means nearly 65,000 rupees per year, you will not pay tax. That is, sorry, 65,000 rupees per month, you will not pay any tax. That's fairly reasonable. The second part on the business person versus this thing is, you see, a business person takes a lot more risk than a salaried employee, a lot more risk, significantly higher risk, and therefore they get the benefit of being able to take their expenses out and then paying tax on the rest, because they're able to take that risk. Now, this fact that they are able to translate it to four people or not will be a result of four individual employees of an organization, in a way, being able to make being able to make that as an income. And you could also do this if you set up a partnership with a bunch of people that you know, that could earn the same kind of income, or you could leave your salaried job and be a consultant to your organization, and therefore you would still get the benefit of taking out your expenses and only then paying tax, or paying presumptive tax at a much lower rate. But since you're not willing to take that risk, the government is going to tax you more. This is just the way of the world, worldwide. The more risk you take, the likelihood that you will pay a little bit lesser tax. This was a little bit wonky when it came to stock market listed equity versus personally built companies for a while. Till now, if you had a personal company and you sold your shares after, I don't know, 10 years of holding it, you paid 20% tax. And you probably bought it at nothing and you sold it at some high value, and that indexation doesn't matter to you. So you pay 20% tax. From today onwards, you'll only pay 12.5% tax, exactly the same as if you had bought a share in the market and held it for 1 year plus and sold it. There also you pay only 12.5% tax. So they've equalized, in a way, the taxation of the riskier asset, or the risk-taking asset, in the capital gains world. But in the salary world, you'll always see that the salary is going to be taxed pre-expenses and business income is taxed post-expenses. Um, at least I think, and I also think that's fair on the risk. But Ajay, if you had anything on this.
No, Deepak, I agree with the points that you made. Nothing further to add there.
Cool. Acha, we do have we have two more people, but before we take more questions, I want to ask you, Ajay, how are you on time? Because we are nearly 10:30.
I'm okay on time because we're just closing out on a few things related to this budget itself. I'm in office, so I have time.
Acha, theek hai, theek hai. Okay, so I think we have Madan and then Rachna.
Yeah. Hello, Deepak sir. Can you hear me?
Yes, please go ahead.
Yeah, my question is specifically for you, and it's on the markets. So there was no big bang reforms when it came to markets as such. So do you think the sectors which have so far done well, like infrastructure or renewables or railways, these themes, is there any big trigger for them to continue on that the performance like what they have been in the last 1 or 2 years? Uh, I would like to know your views about whether these will be the sectors which may perform well in the future as well.
I wish I knew. I don't know the correct answer to these to the forward-looking question, but I don't think there's anything necessarily bad in any of them. There's still infrastructure spending as earlier, defense spending as earlier. There is a stated goal to reduce, imports of finished goods. They have increased or decreased the raw material custom duty for a lot of goods, including for inputs into shrimp feed at one level, and heavy metals and those rare earths have been reduced to nil, so that we can actually start manufacturing or doing some kind of layers of research around using rare earth metals, whether it's in solar panels or in semiconductors. And I think that way the government's pretty much online, so I don't think there is any meaningful negative. And like Ajay had said in the beginning, there is not really a big freebie that has been handed out that is going to ruin or take away from the expenses they had planned for anything else, including the railways. So I feel there is not, there is nothing wrong with whatever is currently going on. But Big Bang हमेशा नहीं होगा यार. I think once in a while you'll get it, but we want more predictable budgets. And we would get more stable tax regimes eventually. We just have to get to that stability level. But budgets need to be more boring than this, to be honest. Ajay, if you had.
Sir, thank you, sir. Yeah, so I had just one more clarification. This is just a clarification. This NSE exchange data today says FII is net sold about 3,000 crores, whereas the NSDL data says FII is net bought 4,000 crores. I just want to know why this much
NSDL
difference
is 1 day delayed.
in these two.
NSDL is 1 day delayed. And NSDL's today's data shows data of yesterday. So NSE's data that you're seeing
Okay,
today
got
is
it.
actually of today, which is a provisional data. The final data will come in NSDL tomorrow.
Understood. Thank you, sir. That's all.
Right. Okay, Rachna and then Ankit, and then I'll add more people after that.
Yeah, hi, thank you. My query is, am I audible? Hi,
Yes.
hello?
Yeah, I can hear you.
Yeah. My query is related to the new income tax or the old income tax regime. See, for someone, based on a personal experience, for us, old income tax regime was beneficial till last year. But we had capital gains, so while paying taxes, the new income tax became more beneficial because there were many tax slabs. Now, in the current year, how do you think it will be individual? I know based on each individual's this thing, but broadly speaking, do you think new income tax will be beneficial given the rebates and the tax rationalization that has happened?
I don't think there is a answer that can be given without knowing what the consequence of income, how much,
Oh,
what kind of income, etc. Because I don't think there is a one thing that can say that this will be beneficial or
fit all.
the other one, which is why really the income tax department themselves have given a tool where you can go and enter your income level based on head of income, and then it will tell you which is your tax under both the schemes. I personally seen multiple situations where you will not know which is beneficial until you actually do the numbers.
Actually, true. Okay, thank you.
My rough rule of thumb is if you're paying rent and you get HRA, you're probably the old regime will work better.
Yes.
And the tax deductions also, and the
And you don't
housing loan,
and yeah, and you
housing
don't have
loan.
other income, because there comes a point where your other income at the lower rate will outweigh the HRA benefit that you'll get on the salary.
Oh, okay.
Correct.
Okay. Thank you.
Cool. Thanks. Ajay, we're okay to go for a few more?
Yeah, another 5-10 minutes is no problem.
Okay, 5 minutes. Okay, Ravi, I think Ravi Sethia is on, and then Ravi Jain.
Yeah, hi, Ravi Sethia here, Deepak.
Hi.
Yeah, hi. So I had a query like when the government is making these changes on, let's say the capital gain changes, which are applicable. So part of it will be applicable for, let's say, the 83 odd days that have passed, or 103 days that have passed, and then rest will be like post 23 July. So how it complicates the next year's ITR. Why does government kind of even make those kind of calls? They could have waited maybe 8 9 months more, and we would have streamlined that. Okay, this year this is the specific rate, because as of now I think there are few clauses which say something is applicable from October as well. So it will just complicate ITS. How does government look at it? What's your take on that?
Yes, it does. It does complicate the competition, etc. But the way I look at it is, if they've taken a decision, why would they wait 9 months to give that benefit where it is beneficial? And if it is not, then if they've taken a decision to increase, etc., they may not want to go back to 1st April, which is one of the things a lot of the earlier governments, a lot of the earlier budgets have happened. To sort of align it to 1st April, you are doing a interim budget and then you've taken charge and then you move it back to 1st April. I've seen those also, including rate increases, dividend distribution tax, etc. So I'm glad that that has not happened. Otherwise, they could have said instead of waiting for 9 months, we'll move back 4 months. We'll make it effective from 1st April, which is the entire financial year. Nothing really would have stopped them from going back on some of the things, but they couldn't have imposed some of these additional taxes on old transaction. I think yes, mid-year does pose a challenge, but it's end of the day, you've taken those decisions, you want to get implemented as quickly as possible. You would want to move on. Some of these also have revenue implications. They would have done their math, and I think that's what it would be.
From just yeah, I get your point, but just from a technology product perspective as well, I think it will require a lot of changes in the idea portal. Then likes of ClearText and all have to change. Everyone
Yes,
just goes for it off, and people do end up messing up their ideas because people are not aware that on 23rd July I had to change the
right.
capital gain
No,
limit, right?
in fact, even in
A
the
huge
past,
load.
no, even in the past, see, some of these you would not want to give a longer thing as well, right? People can plan. So even when they brought in long-term capital gains on listed equity, it came in mid-year on, if I remember, it was 31st Jan or something like that. Because 1st Feb was the budget that day, and they said as on 31st Jan 2018, if I remember right, they said that's the date that they'll take as a cutoff. So when they are introducing something like this, you would not want to give a long window for people to plan their affairs, to move into long-term, short-term plan. For example, indexation and things like that. If you wanted to bring in something like this, you gave time, then people would sell and buy and get an index cost, and you would get into different problems, and not just the technology thing of tweaking some formats and things like that.
Understood. Thanks. Yeah.
Oh, sorry. Yeah, I thought I was on mute. Ankit, if you had a comment, we'll quickly run it and then I'll give it to Ravi. Jain, that is.
Yeah, thanks a lot. Firstly, really, really helpful from a range of topics. Two broad points that I wanted to pick up, or rather ask the panel. One, what is the change that happens on rental income from properties? There is some change earlier, you could set it off as business income. There's some change.
Sure.
So, how does one really tackle
So
that? The second question was more on how on the HRA itself. If is it necessary that one actually goes through this landlord route? Can it be switched over to say a family moving into a service apartment, and the service apartment essentially can be claimed as HRA? Wanted quick views on that, please. And thank you again for the overall session.
yeah, so on HRA, I'll take the second one first, and I think that's more on what would be treated as rent for housing, and there's also an angle of what your employer would be comfortable with and what policies they have, because some of the employers I know for a fact to be absolutely above the board don't permit rent payment among family members and claiming HRA, etc. So there is a bit of what is passing the smell test, etc., and what they would put as additional things. From our law, I don't think there's any restriction on what you would pay for accommodation. If it's going to be a serviced apartment, it could be a serviced apartment, but you need to be paying that rent and having an agreement for, renting out that property. It can't be for a 10-day period in a particular place and then a hotel, etc., because there's a separate treatment for hotel accommodation provided by the employer. That's slightly complex. So on the the first part of rental income, they have brought in an explanation to say any income that you make from renting a a residential house or a part of it will only be taxed under house property and not under business income. I can think of two implications. One is, people who are offering either Airbnb and paying guest, etc., renting out one room in the house and all of it as business income, claiming expenses, etc., would be impacted, because now it would clearly be, if you have income from letting out a residential property or a part of it, that's how the law reads, it would only be house property income, which means that you don't get deduction for expenses other than the 30% deemed deduction that is there. Second is a slightly complex thing, which is last year's budget, they brought in an amendment where real estate companies are owning unsold completed residential houses. They brought in this concept of deemed let out, and they had to pay tax if they held residential property which is not sold. And some of the companies, possibly moved it to stock in trade rather than an asset that is held for sale, and then try to offer it to business income, and those would be impacted. These are the only two cases that I can think of which will get impacted. But otherwise, the proposed amendment simply says that if you're getting income from renting out a residential house or a part of it, it has to be only house property income.
Thanks. This clarifies a lot. Thanks, Ajay.
Thanks so much. Ravi Jain, thanks for waiting. Uh, Please go ahead.
Sure. Yeah. Thanks, Deepak. Good discussion, right? So my question is on the NPS contribution front, right? The section 80CCD2, right? So there has been a minor change which are now allows even the private employers to contribute 14% instead of the 10% earlier.
Correct.
How do you see this move, and do you also see that, given the fact that things have been changing, right, even on the LTC and other stuff, do you also see that there can be a potentially taxation on the withdrawal from NPS?
It could be
in future?
NPS. NPS is not really, as if you would be following, it's not really taken off as well as they expected it to take off. And it also depends on what the employers are permitting, comfortable with, not, etc. This should give it, but from an overall policy perspective, this government has been quite clear, and in their earlier terms, not really the third term, that they would eventually move to what is a EET taxation, which is the earlier all these retirement things were exempt, which is you exempt when an employer contributes, your accretion is exempt and your withdrawal is exempt. They actually want to move into a taxation at the time of contribution, which they have done beyond a certain limit. Accretion to that by way of interest beyond a certain limit has already become taxable. I think eventually we will move towards a situation where withdrawals could potentially become taxable. They may want to move to that regime, but it's anybody's guess.
Cool.
Sure.
I
Thanks. And
think
how do you see this move from 10 to 14?
I don't know if that's enough to make this attractive. Really, not somebody who's been involved in advising companies on retirement schemes and how to implement. So I may not have full visibility on it, but from what I can see, I don't think it'll be too much to move the needle.
Okay. Thanks.
cool. Awesome. So I think this has been great. I know that Ajay, you had said a few more minutes, so we're kind of past that. I think perhaps best to close it for today. We can have. It looks like there's so many requests. I'm so sorry I could not get to all of you, but we do have a. I mean, I don't want to keep Ajay here longer than we can keep talking till 12, of course, but time beckons. Thanks, Ajay.
No problem.
One thing I learned today was that if you're a listed ETF, most likely, regardless of what you hold underneath, your long-term capital gains happens after 1 year, and it's only 12.5%.
Yes.
This gives a way out for maybe some debt fund investors who will find a way to get debt returns after without the taxation issues with debt mutual funds. But I also feel that if many people take advantage of it, and mutual funds start creating debt ETFs, that the government will plug this loophole in the next budget, and that may not be beneficial. So that's something I learned today. But thanks so much. And Ajay, yeah, you want to say thanks so much, and you want to give any closing comments?
No, Deepak, I think this was good. Thanks for getting all of us together. It's been good. Thank you so much.
Great. Thanks everyone. I'm sorry I couldn't get everybody else to speak. I know we've got a lot of requests, but it's 10:45. We should perhaps speak again maybe later this week. Once perhaps the government has also had a chance to clarify any of these things that have if there are any further clarifications required. Sometimes the government does come back and say, okay, well, we'll overlook this. Let's see what happens. We can do another space. But thanks so much for watching. I'll close in about 10 seconds. So if you guys want to follow people that you see here, follow the speakers, and thanks to everyone who's come on and asked questions as well.